So the third component, so we talked about the vessel, the structure. We've talked about how to go from old co to new co. The last part is, how do you finance this? Very few of these conversions involve a closing table with employees writing a check big enough to pay the owner out to, go retire to the Caribbean. So the reality is, these have to be financed. And most of them involve seller financing. The seller will agree to say the value of the business is worth this. Some or all of that value I'm willing to take as the principal on a promissory note. We've done these from 30% seller financing all the way up to 100% seller financing. Everything from 1 year to 10 years. We've also done this with sellers that take voting or non-voting preferred stock instead of a note, which can then convert into a note. So there's all kinds of possibilities. But in other words, the seller's getting paid back over time, and they're getting paid back out of the operational cash flows of the business, not a liquidity event, and not I'm going to take half the balance sheet with me. Employees do contribute. Very often, employees are putting up some amount of capital up front, but they're also earning equity. There are ways of doing this both in terms of paid-in capital and earned-in capital. We'll talk a little bit about that. And then we also specialize in outside financing through direct public offerings, private offerings, crowdfunding of debt and or equity. There's ways of raising money from the community. And then we'd be remiss not to mention the USDA program that offers bridge financing and grants, the SBA 7A program, which Wes talked a little bit about, and then standard lines of credit and term loans from banks, and then down below the bank alternatives, community development financial institution.
The USDA is great for grants for feasibility studies, especially in the rural communities. So if you've got clients or associates that you know of that are interested in this subject, then that would be a good avenue to take. Employee ownership can also mean that the employees themselves help contribute to the financing. And they can do that with direct capital contributions. We have some worker co-ops where the membership fee to become a member is quite small, $100. We have some that go up to $10,000, $15,000. So, and it could be only a portion of what's required for the sale of the business. But we find that the employees that do contribute some form of dollars to the capital of the company have a more invested interest and are more interested in making sure that the co-op does what they want it to do. They can get loans from CDFIs. Is anyone familiar with per unit retains? It's a form of cooperative financing where the members agree with the co-op up front through a contract that the co-op keeps either a percentage or a unit-based number of whatever the member sells through the co-op. So this is usually done with cooperative organizations where you've got independent contractors where they're selling products through the co-op that they've produced. Whether it's a piece of artwork, whether it's some data and coding work, the co-op keeps a percentage of that. It's called a per unit retain, 1%, 2%. We're not talking big amounts here because it accumulates over time. And the co-op, it goes into a capital account of the co-op, not in the member's name, but as a capital contribution to the co-op.
We generally have seen in our experience that the employee or worker member equity should end up somewhere in the 10 to 30% of overall total equity. There needs to be both for financing purposes and also, I think, for practical sense of ownership that the employees have a meaningful percentage of the equity pie. And I don't mean that in the traditional equity sense. I mean that if you looked at the balance sheet, the member equity accounts should total between 10 and 30%, ideally more, but at least this. And that will likely be necessary for outside financing and almost definitely for bank financing. So we, as I mentioned, when it comes to outside financing, work hand in glove with these conversions to do the financing work through either a Regulation D private offering, a direct public offering, or crowdfunding. We just did a conversion in Massachusetts involving a direct public offering. And so the purchase price will be entirely financed through a DPO. We've done these through private offerings, and you can raise quite a bit of money to do that. And if there's a seller note, that gives you some time to put the prospectus together and do the proper disclosures.
It doesn't have to be all or one. You can have a combination of seller note and direct public offering, and whatever vehicles that you choose with the employees and with the owners that make the most sense for your organization.
And one thing to mention here, especially with multi-stakeholder co-ops, if you, for instance, include, let's say, your vendors or customers, or if you've got major institutional buyers, hospitals and hotels and restaurants, for instance, at least in Colorado, and I would suspect this is the case in the Washington Limited Co-op Association statute, any contributions, any capital contributed by a patron member is exempt from the state securities registration requirement. This is nearly a categorical exemption that's self-contained. It's a self-executing exemption, which means there's no notice to the state. We've been able to help co-ops raise well over $1 million from their community by creating legitimate classes of ownership that have them contribute capital in what would otherwise be a securities offering. It's quite amazing.
What did you call that again?
It's called a securities exemption, but it's anytime you raise money,
State securities.
you have to register the offering with state regulators. An exemption means you are exempt from having to register it. Co-op statutes, at least the LCA, has a pretty broad exemption from registration.
Okay, so that gets around the SEC rules as well.
At the state level.
State level.
At the state level.
What about the federal level?
So if it's done with investors only inside your state, you're already exempt under Rule 147.
Okay, got it. Okay.
And if it's an operating company, Rule 147 allows you to do that as long as 80% of the proceeds are used in state. That's not hard to do. If it's also interstate, you can still do it under either 4A2 or 504.
Does that include preferred shares, or is that?
Yes. Well, depending on your statute. So in Colorado, the statute is actually explicit. Any contribution, including preferred equity, contributed by a patron member. It has to be by a patron member. Any offering to an investor member who's not a patron member, that's a securities offering. But if that person writing the check is a patron member, our statute is clear and it says that's exempt from the state registration requirement. So again, if you have a worker-owned business, include a class of ownership from some of your key customers. They have to be legitimate members. They have to get patronage for their purchasing through the co-op. They could contribute hundreds of thousands, millions of dollars in preferred equity and that could be exempt from registration at the state level.
We haven't looked at the new Washington statute, but just glancing at it in the last couple of days, it looks to be very similar to the Colorado LCA statute. So it will probably be the same, but you need to definitely have your attorneys look at that.
And look at the other co-op statutes too, at least ours. This exemption is in all three of our co-op statutes in Colorado. It may be available in the other co-op statutes in Washington too. But that's a significant, so he talks about major tax benefit under 1042. This is a huge securities exemption. So at the end of the financial planning rainbow, we make sure that our clients at least are well familiar with what their balance sheet looks like, what their financing needs are, and we do that on a pro forma basis, meaning we do that before we do the conversion. We model out what their capitalization is going to look like with financing and a seller note and member equity. We talk about what their balance sheet's going to look like. We plan for growth. Very often these conversions are accompanied by a strategic shift. The employees want to see kind of a new vision to get excited about. That usually costs money. And it's not just flipping a switch. Going from selling owner to employees is usually some pivot, and we have to plan for that. And then we also have to figure out the methodology by which patronage will be allocated. And again, Linda said that can include a weighting factor, and the board can adopt that in a policy. So there's some thought to be given, and we'll kind of gear up for that at least before the conversion.
You also need to consider your cash flow, obviously, and think about how this is going to be financed. You have to plan for employee leaving. What happens when they leave? What happens when they retire or they become disabled? What happens if you have to fire an employee who is also an owner? Those are all policies that the board has to put together, and you have to think about the financial situation of the co-op. Many co-ops set up redemption or retirement policies that are very explicit. For example, we have one co-op that says if you leave before a certain time and you've got equity in your equity account, you agreed to a discounted redemption. Others agree that if you've got a large, over a certain dollar amount equity account and you retire, it may be paid back to you over a period of years in the form of a promissory note with interest paid by the co-op to the retiring employee. Usually for estate planning purposes, we advise our clients to set up policies that if an employee dies, that their equity account is paid right away. Some state estate laws don't like long-term payouts of old accounts. So that's one thing. So equity redemption planning is very important, and you can set it up in a variety of different ways to fit the financial situation of your organization.
I own a small business brokerage down in Olympia called Sound Business Brokers. So what I do in my day life, my real job, is I'm one of those guys that Jason had mentioned that people go to sell their company without telling anybody about it. So that's what I do in my daily life. I also do value opinions for folks to try to figure out kind of an educated guess on where their business value might be. And you might be asking, well, what qualifies me to do this? And my background, when I was 19, I decided college wasn't for me, and I really wanted to do my own thing, and through a variety of real weird kind of luck, fate circumstances, I ended up buying a small heating company in Washington, in Seattle, oldest heating company in the state. And probably about the dumbest thing a bank could ever do is give me money at that stage in my life. And the employees took pity on me and actually helped the company grow. And by, I think it was about 12 years later, we sold it to Lennox. We had 90 employees. And I helped the 3 core employees that were with me, gave them a gift to start their own heating company as kind of a gee whiz, thank you. Thank you for not bailing on me. So during that time, bought about 8 or 9 other heating companies and went through my own sale. And that sort of led me into business brokerage in kind of a weird way. Probably too long of a story to go over here. But so what I do with the Northwest Cooperative Development Center is when they need a buyer and seller to just kind of get an idea of where the value of the business might be. And there's a couple ways of going. Jason had mentioned, outside appraisals. Mine is not a certified appraisal. It's what's called a value opinion, and it's just one guy's guess as to how much that business might be worth. And it's a good starting point so that the seller and buyer can have a starting discussion, a starting value, and they can talk to each other and move that value in one direction or another. And then there's also certified appraisals, which I do not do. And it's those are really designed more for like divorce or probate or partnership dissolutions, and they're a little more expensive. And what I've found is they're not asking the market questions. It's kind of like that real estate agent that comes out to your house and knows the market and knows kind of how much your house might be worth, versus an appraiser from Seattle coming up to Bellingham and kind of doing comps and not asking a whole lot of questions, but the bank is going to use that, whereas your agent might actually be a little more in touch with what that business might be worth. So has everybody heard the term EBITDA before? Yeah? Okay, so yeah, I know you have. So EBITDA is called, for those that don't know, it's earnings before interest, taxes, depreciation, and amortization. Now this is where it gets really exciting. Okay, so they've saved the most boring for last. Anyway, a lot of people use EBITDA as a way of gaining kind of the number value and then assigning a multiplier to it. So what that is your bottom line income with depreciation, amortization, and interest added back, and then it also has a management component in it. Where that goes wrong with co-ops is that a lot of the co-ops that we're dealing with, I know you've dealt with one that was $2 million, but a lot of the ones that I've seen are way under that, and they're a Main Street owner-operated business. And EBITDA is generally a calculation of a business that's netting $800 to $1 million. And so what we use is a hybrid of EBITDA, which is called seller discretionary earnings. And this is what Linda was talking about, where people run all kinds of personal stuff through their financials. I'll give you kind of a personal example. Yes, in the summertime, I'm busy and I have somebody come out and mow my lawn at my house. Sometimes that ends up in my repairs and maintenance line item. Now, I'm not telling you to do that, okay? But if someone were to look at my books, that's, they might find a $500 expense in there for my guy to come out and mow my lawn. And so, business owners do that all the time. And it's not necessarily that they're being nefarious about it, but over the years, Uncle Joe might say, hey, run that entire European vacation through your vacation. When you get to Paris, mention your business to somebody and then write it off. Well, okay. Now, when you go to sell that business, that's not a good thing, because you're telling all kinds of stories amongst your financials, and it makes it harder to finance. It makes it harder for people to believe you, and there's all kinds of things. But when you go to look at it, you're going to find certain things in financials, especially in small businesses. So the traditional way of valuing a business for an outside entity is we add all of those personal expenses back to the bottom line, including depreciation, amortization, and interest, and we come up with a number. So let's say it's like $100,000, right? And we add back the seller's salary or wages or whatever they took out of it in wages, all right? So let's say it all adds up to $100,000. Typically, in the traditional method, we're looking at a multiplier of that based on maybe 20 to 25 micro risk factors in the business. So if you've got a high client concentration, all of your income is with one company, that value goes down, that multiplier goes down. If you're in a business like mine, which I'm the entire brain trust of my company, yes, I've got a couple other guys, but I'm it. If I got hit by a bus, there would not be a company. That value goes way down, right? But let's say you've got management in place, you've got systems in place, all of your policies are written down, the multiplier begins to go up. So, no company is perfect, and it kind of bounces around and then comes out as an average. And usually with Main Street businesses, we're looking at a multiplier of 1 to 4. Okay, this is 1 to 4. And this is in a traditional sense, okay? 1 meaning, oh my gosh, I really want out of this business. Or I will pay you $10 and here's the keys, right? In my business, the multiplier would be way under a 1. I mean, it would be, I'd have to pay to get rid of my business. Now a 4 is, the business was created by God. It's infallible, right? The Pope buys all of his businesses from me, I mean, that kind of thing. And really, to tell you the truth, really, businesses really are very rarely 1 or 4, okay? Because there's good things in a business, there's bad things in a business, and they just kind of do this and kind of come out the other side. So let's say it's a 2.5. So our example of a $100,000 net and a 2.5 multiplier would make that business worth $250,000. And it converts it to an investment. So how's that different from a co-op? So in the traditional value model, we are assuming that we're finding a buyer to take over as a clone of the seller, right? So the seller is operational, they're running it, so we need to find somebody with their skill set to run it, and hopefully the employees will stay, and they're basically buying themselves a job to get in there. Co-op, that's not necessarily true. So co-op, there's a lot more governance issues around the sale. In a sale to an outside entity, you're assuming same governorship, just different head. With a co-op, everybody is in it, right? So as a valuer, right, as somebody that's putting a value opinion, first of all, I have to find out if the seller is going to be in the co-op and stay. And if they are, then we can't adjust any salaries back, but the risk level goes way down because you already have somebody that has extensive operational experience in the business. And that's true even if the seller doesn't stay, because employees are very, very knowledgeable within the business. So generally speaking, the risk levels are lower than an outside entity coming in to buy it. So if the seller isn't going to stay, there is a possibility of adjusting some of their wages to the bottom line, but we have to determine whether their skill set can be distributed amongst the other, soon-to-be owner-operators. And if the seller has a special skill set, can it be transferred in a transitional period somehow? Can it be, can you open up the employees' heads and pour in the knowledge? Or if it's very unique, then you might have to hire it. And sometimes sellers aren't paying themselves market wages. Give you a quick example. We did a software company, and if you looked at it traditionally, you would be adding, the sellers didn't want to stay, you'd be adding the sellers back to the profit, and then that would increase the value. And that's what the sellers did. They did their own, they Googled it, they Googled the formula and came up with kind of their own feeling, right? Well, as it turns out that those sellers, even though they worked part-time, their wages were per hour. They didn't pay themselves a salary. They paid themselves per hour that they worked, which was kind of novel, really. I mean, if they weren't at the office, they weren't getting paid. So the question from the buyer was, well, how can we add that back when we have to hire somebody to, replace what they do? I mean, they're computer coders, right? They're software coders. And that kind of blew the seller's philosophy out of the water because, you couldn't add them back, which affected value quite a bit. So those are some of the main things that you look at within a co-op. It's more important to look at how it's going to be governed and the employee structure than really cash flow. I mean, cash flow is important, but as far as risk factors and things, it's really about how you've got all the bases covered within the organization. And it's unique. So I think, I did want to piggyback onto Diane's comment about the success rate of selling businesses. I will say that I'm pretty successful at selling businesses, and I'm above the national average. So that's my pat on my back. But I just got back from a conference with the International Business Brokers Association to maintain my CBI designation. And in one of the seminars there, they talked about success rate, and success rate of businesses in under $1 million in enterprise value was right around 24%. Pretty bad, and that's the majority of businesses for sale. Now, that didn't include, those represented by Wes Martin, okay? But I'm just kidding, actually. I mean, a lot of those were for sale by owners, and maybe they didn't have right pricing. There's a lot of variables that go into it. But to piggyback on Diane's comment, it is very, very difficult to successfully sell to an outside entity. You have to find the right fit. So that's why co-ops make a lot of sense, actually. Now, hopefully there'll still be businesses for me to sell, but co-ops I think are really a good model. And when I think about my own company, we had 90 employees when we sold. I kind of wish I had thought about it, because the company that bought my company tanked it. And luckily it's still around. Somebody else bought it from them, and they're doing okay. But in the video that you guys showed, the training, the financial training with employees, and I did that with my employees, even though they were not owners. But I wanted them to have a feeling of buy-in and really know the challenges that we were up against, and what increased cost of goods was happening to our bottom line and things like that. And we paid bonuses and things of that nature. So I think that's important as well. And so I think that's it. Any questions?
Well, aside from not knowing what to do with appropriate business practice, what else contributes to this low percentage? Personality factors?
Oh yeah, there's
What would you say would be the primary contributors to this low?
probably ego.
Ego.
Mm-hmm. Because when you're selling a company, you're already sort of wanting to check out, right? You're exhausted. You've been at it for 15, 20 years or whatever, and you know that you want to sell. But then here comes this bright-eyed, bushy-tailed whippersnapper coming in saying, oh, look at all the things you're doing wrong, and I'm going to do this, and I'm going to do that, and I'm going to blah, 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 blah. And then you're going, you're insulting me, right? And they don't even know that they are, but the egos clash. You've got Mr. Optimist and, Mrs. Pessimist, and they're just, and that's where a broker helps mitigate some of that. When I'm communicating between the parties, I'm not communicating everything that's being said, because a lot of it is just venting. And going through my own sale, I can really attest to those emotions. So I would say that's probably the number one.
Could you take a stab at estimating the average valuation of the 25%?
Of the ones that sold.
The ones that do go through LCS, what would the average that?
Well, I think that the statistic I saw was just in businesses under $1 million. So I would say that the lower the value, the less likely it is for them. So most businesses that are for sale are probably way under $1 million. So like maybe under 300,000. And those are harder to sell because they're harder to make pencil, economically. Yeah, and yeah, you got an owner that means everything to the business, and it's tough. Yeah.
Another question about sort of the capital stack of the structure, the financial structure of the buyout by the employees. I'm not sure.
So am I done?
You stay involved with the full acquisition? Or
I do, but not in a cooperative sense. So my only role is when the buyer and seller are having trouble agreeing on a number, and I'm just brought in as a third set of eyes to say, this is what I think, and take it for what it is. Like I said, I don't do certified appraisals, and if there really is still conflict after a value opinion is done, maybe a certified appraisal is a way to go.
And do you tend to find more value than the certified appraiser or less?
I'll probably less in some cases, in most cases, just because a certified appraisal doesn't ask questions like, how many relatives are in the business, what kind of client concentration there is, how are you going to replace the seller, are you paying market rent, are you paying market wages, what about benefits, things that should be asked usually aren't, and you get this sort of weird number and then a multiplier, and some certified appraisals use a discounted future earnings method. Anybody know about that? Yeah? What's your opinion of that method? It's pretty cruddy, huh? Yeah. So basically, discount future earnings, you're telling the buyer that, hey, look, we've had a 3% growth over the last 5 years. But we believe that in the future, it's going to be 10% every year, right? And there's not going to be any ebbs or flows. It's just going to be roses, roses, roses. And then you come up with a number and you discount it, and you add it to cash flow, and voila, you get this value. Well, in my opinion, just being an owner-operator myself, those numbers have to be done under the buyer's steam, right? It's their risk, it's their effort, it's their sleepless nights to do that. And I find it hard to attach value to something that the company hasn't done, unless the seller has sold contracts to the military, government, big entities, things that are for sure guaranteed income or pretty close to being guaranteed income, then they should probably get some credit for their effort in selling that. Does that answer your question? I do. Yeah. So I'm available for questions. Anybody else? No? Okay, well, thanks for letting me, ramble.